Namaste, Sat Shri Akal and Adab. This is your host in those Sunil Jhaveri, also known as Mr. Bond in the mutual fund industry, welcoming you back to another episode of One on One with Mr. Bond. Our today's guest is MD and CEO of Motilal Oswal, Mr. Prateek Agrawal. And I'm going to discuss with him a very different topic, a topic which is not really covered by many channels also, many media people also. Are we so decoupled from the world macros? Can India take the world along on its own steam? And what are the different macros in the global context pointing us towards different asset classes and their movements? So welcome, Prateek.
Thank you for having me.
So Prateek, the first macro which I wanted to touch upon was inverted yield curve. When a yield curve gets inverted, where the 2-year yield quotes higher than the 10-year yield, and it's been there for the longest period of time in the last so many decades now, from 2022 to 2024, the US yield curve was inverted. And when it uninverts, which is the current situation, the recession is likely to be 6 months to 12 months down the line. So how do you read this? Is it going to be a soft landing or a hard landing as far as US markets are concerned, US economy is concerned? And how does that impact the Indian markets?
So that has been the direction of policy making. So the Fed has been tightening over the period that you have outlined. And just look at this. The aim of any policy is to keep the economy growing in a sustainable manner with inflation under control. Now, in the US, there are just about 30 odd crore people and all of them are employed. So it's very different from an economy like India. If all of them are employed, and in fact, more of them were employed than what a US Fed would have liked, it was causing inflationary pressures. So they just tightened. So to let some steam out. And now, when the unemployment numbers are showing a tad higher, which maps to also your thoughts on how the economic growth would be, they have started to reduce rates. We have had 2 rate reductions.
Correct.
So I think this is what it is. Now, impact on India, well, let's look at it. For us, 18% of our economy is exports. Okay, the world, it's not only US. US is 25%. The world, let's say, grows by a percent lower. Our economic growth gets impacted by 0.18%.
Correct.
Very
so
negligible. That is very small, and that is one part of it. Just because the world is growing slower, you also get cheaper oil.
Right.
Just imagine with Russia, Ukraine happening, with Israel, Hamas happening, with Iran jumping into it. If we were 6-7 years back, would oil be at closer to 70? It would have been probably closer to 100.
So that's another macro which we are going to touch upon. Yes,
But
absolutely.
you should never look at the picture with one side. What you are losing in terms of global growth, you're more than making up by savings on lower crude prices.
Sure. So the other index, which the macro factor which people generally see is the dollar index. The dollar is strengthening against a basket of 6 currencies and also against rupee also. It's already gone up above 106 today. It's 106.5 or something like that, which shows that there is a flight to safety or flight to safe haven, which is the dollar assets as the world sees it. So the other emerging markets see outflows, which is happening from the Indian context also, and they buy dollars, and that's the reason why the dollar index goes up. So dollar index can be viewed 2 ways. One is, of course, the impact on the emerging market flows, and the second one is that there is a recessionary concern, and that's the reason why flight to dollar or flight to safe haven assets like dollars happens during such periods. So how do you read this dollar index, and is this going to continue in terms of the FII pullouts?
So once again, there is a driver of it, and then there are various parameters which will point to the same. So if for some reason bond yields are where they are, 4.45 or higher, well, they're just too attractive. Why would people want to take other market risk when they're getting that kind of returns risk-free in their own country? And obviously, when they pull back money into their own country, dollar index will look like in a particular manner and so on. So that is how it is. So till the bond yields continue to be where they are, I think money flow back into the US should be expected to continue. However, what we are talking is in the month of November, mid. October was different. October actually equity market ETFs got in record amount of money. The not so good news was most of that money actually, if the ETFs got 100, went into China. That was a month when Chinese did very well. So all the emerging markets lost money to China on an overall basis. But yes, as Trump came in, bond yields moved up, and today the dollar index is looking higher. Money is going back into the US. It stands to reason. I mean, if you were an US investor just now, and somebody comes and pitches to you that,
Yeah, why should you look
if
outside when 4.5% of risk-free return is available in your 10-year US Treasury yields itself? I totally
absolutely,
agree, sir.
there is no case just now.
Yeah,
So
yeah,
our thought is the US pool of asset, emerging market, especially active equities, should be seen to be stressed. I mean, there is hardly any logic. So you won't get inflows. You
correct.
should be expecting normal outflows. They will also need some monies for consumption. So, one is various countries jostling with each other in terms of attractiveness. So China took away money last month. We may be pulling in some next month and so on. But overall pool would be reducing. So everybody should be getting some outflows.
So this hit is a normal hit because this is a very logical step where the risk-free return is on the higher side. Why would people not pull out and then get back into dollars? Now the money supply, which was contracting, there was a quantitative tightening which was happening from 22 to about 23, 24, is all of a sudden started to rise again. The money supply in US I'm talking about, and that's inflationary again in nature. So, the 10-year US Treasury yields, as we just discussed, in spite of two rate cuts, has gone up by almost 80, 85 basis point from September to now. So is the 10-year US Treasury yield seeing something which the equity markets are not seeing in terms of A, inflation going forward, and B, slowing economy in the US context right now to start with?
No, really speaking, depends on if one is looking at a month, 2 month, 3 months, 6 months, 1 year, 2 year hence. So the period of vision is very important. With whatever we have heard that Trump will end up doing after coming into office, all points to US economic growth, particularly in the manufacturing space, particularly in the strategically important spaces like semiconductors, should be expected to strengthen. So that is how it is. Why the bond yields are up is because of an imminent threat of inflation. So if you increase import duties, US consumer is going to pay for it because America can't manufacture everything. It just doesn't have people to manufacture. And people don't want to work in hot, humid conditions. It's a services-led economy. So we will continue to import a lot from outside. Maybe the sources will change, hopefully away from China into countries like ours. That's the big hope. But the American consumer pays a tad more. If American consumer pays a tad more for whatever comes in, yes, it is going to be inflationary, and the bond yield shall reflect that. So that is what is happening to our mind.
Correct. And that, the deportation also is what I read somewhere is that is going to be not really beneficial for the US economy because the labor, where will they get the extra labor which they were looking for? So that's another aspect of manufacture in US will get impacted because of this deportation drive also.
Yeah, they shouldn't actually be regularizing it as we as a country keep doing it. Or maybe import a crore of us into the US. A lot of people will happily go there. So yeah, they don't have hands to move the machines. So they will probably choose the most strategic parts. To most of us, that means the semiconductor eco chain, where they would want to build more in the US.
Sure. Now let's talk about the US debt, Pratik, which is it's unheard of. $36 trillion. In last 1 year only, it's added about $3 trillion to its debt. It's adding almost 1 trillion every 100 days. Your fiscal deficit numbers are humongous, almost $2 trillion and 6.3%. Now, all these are very inflationary in nature again. So, will this and the interest burden is now higher than the defense budget, which has never happened in the US budget so far. So, all these are extremely inflationary. All these are showing huge debt, burden as far as US is concerned, and the debt is going towards unproductive, like paying off your interest rates, debt, etc. So how good is this for US economy and global economies also? Because if US slows down, China is already in a slowdown mode. Where will the world? What does your global scenario look like?
No, so one should look at a country and see what is the growth rate it can sustain. Now, each country has a different growth rate. It depends on the factor of production that the country has. So it is people, it is land, it is resources, raw materials, technology, etc., etc. Resources include, of course, financial resources. Now, uh, where we believe US hits the wall is in having an economy which is at full employment, and hence the potential rate of growth falls a bit. And hence, like we were discussing in the earlier question, if they have people from outside wherever into the US and get them to work more. Well, they have so much of mineral, they have so much of land. They are the reserve currency of the world. So a lot of the issues that other countries will face on debt, they face less. I think that economy can grow faster. Or or they can choose to do what they think is strategically important internally and ask allies, where again there are peoples, instead of importing them into your country, you say, okay, I'll give you work, you do it in your country and send the stuff to us. That I think is the chosen route. Because importing people into a country also has issues,
Correct.
of assimilation, etc. So you do it in a small manner, and of the developed world, US has kept its population younger. It's not an old country, kept its population younger. So one should not mistake, or one should not, I think, be worried about what will happen to the US. It will do fine.
Okay, okay, sure. Now you talked about US being a reserve currency, which is a fact currently, but there is a de-dollarization which is happening. So post Ukraine war and the US sanctions against Russian assets, etc. So most of the countries are doing their bilateral trades also, and they've started creating their currency reserves into precious metals like gold and silver. And of course, they are talking about BRICS currency also going forward. Of course, it's a long way off, but the de-dollarization and the debasement of dollar and its purchasing power because of excessive printing and this kind of debt, uh, is it not good for precious metals like gold and silver?
Yeah, so precious metals like gold and silver have been on a rocket. They've done very well. They matched up to US and Indian equities in terms of giving returns. So what and actually Bitcoin. I say gold is Bitcoin of the past. You may say Bitcoin is gold of the present, whatever.
Right.
Uh, so all of those assets have seen reflation.
So, but that has already happened. But post Trump coming to power, the gold and the silver prices have taken a step back in terms of retracement of the values. So do you see 2025 because of all these scenarios which we talked about, except for the dollar, which is appreciating, which is a negative thing, but the Fed cutting rates, the debasement of dollars, the excessive debt in the US markets, the slowing down and the inflationary pressures, all these are good for precious metals. So what do you see precious metals in 2025 and beyond? Should that be a good diversification for Indian investors is my question actually.
I'm always for some bit of exposure to precious metals. Uh, Long period returns from them have been good, so one should have some exposure there. Uh, so that is the short answer. Now, a longer one is that whenever a crisis happens, whenever there is an action, people may not speak of it, but they prepare themselves well so that that kind of an action does not impact them. So, if Russia, for example, keeps its reserves in dollars, and when it needed it, it did not get it. That was a very rude wake-up
Shock.
call for the world. And you have seen us get our gold back into the country. Otherwise, it was okay wherever it was.
Yes.
You are seeing the world trying to diversify away. You are seeing the world get more into gold. World, it's not us. It is practically everybody getting more gold into their reserves and so on and trying to diversify. So, less said, these things are not spoken. But वो जिसको कहते हैं ना, if you get a diabetes, then you will start to take medicines continuously over a very long period of time. So this is what it is. You have been woken up. You thought world is a nice place and people will respect a few things. Well, those things have not been respected. There are learnings, and you need to be prepared. अब तो आप नहीं बोल सकते ना कि हमको नहीं पता था.
So what do you recommend? 10 to 20% of the portfolio should be in precious metals at all times because that can give you
Uh,
a cushion and it becomes a good store of value.
Not my area of expertise. Best left to guys like yourselves, but some.
Sure. So now coming back to the 10-year US Treasury yield. Now, is the debt market seeing something different from what the equity markets are seeing? Because US markets, equity markets are still on a roll, post Trump coming to power also. Whereas, which is a different case as far as the emerging markets like India is concerned, where we have come off almost 10% from the September highs, but that also after such a long run of bull markets. So is debt market seeing that slowing down of economy, inflationary pressures going forward, and what equity market is not seeing in the US context?
See, let me try and marry the two. So yes, you are right. There are different takeaways if you're looking at debt and versus if you're looking at equities.
Correct.
Now, whatever debt is looking at, slowing economy, etc., that you are pointing out, points to slowing sales. Equity markets are, yes, sales of a company is the start point, but they are more focused on profits. Now, what will happen to profits if there is a tax cut from 21 to 15? It
Correct.
moves up, doing nothing. Sales can move down by 1%, still profits move up, right? Similarly, what happens to profits if you increase import duties? Move up, right? And which is
Correct.
what the equity markets are celebrating.
Right.
To my this thing, judgment, if all of what has been spoken about happens, by doing nothing, US corporate earnings will move up
The
by some
margins will go up.
5 and 10%. Yeah. So why should the markets not celebrate that?
Right. Now, coming to the geopolitical issues that you rightly pointed out, in spite of so many wars, the crude oil is below $70. Now, is that pointing to a recessionary trend, the slowdown in economies, slowdown in Chinese demand, slowdown in US demands, etc.? Is that what we are seeing going forward, 2025?
To me, it just points to that there is too much oil in the ground. And versus earlier, when people wanted to prevent others from bringing it out and selling in the market. So you did something to Venezuela and you did something to Iran and all of that. Now people are fearful that it will stay in the ground. The
Wow.
way electrification is happening, the move towards renewable is happening. One should look at cost of energy through solar plus storage plus wind versus, let's say, coal. Coal is cheapest for us, and
Correct.
convergence is happening for 24-hour power, right? In the US, it could be competing. So they don't do with coal so much, they do with gas and oil, uh, where it should be cheaper already. So, you actually are looking to bring out more oil and telling other people, ki, boss, give me market access, you please don't supply. That is
Right.
what is happening. So now the fear on oil is opposite. There is just too much of oil. It is
Okay.
not what we grew up with, the world will run out of oil in 20 years. So
Right.
first 40 years of my life, I believed world will run out of oil in 20 years. And you were worried. Now it's not going to happen. It's
So
just
what
too
I'm
much
hearing you
oil.
say, Pratik, is that the reduction of the oil pricing in spite of these wars is not because of the recessionary trends in the globe, but more to do with alternate resources or
But there
alternate
is
energy.
there is just too much oil. Have that narrative and see what happens. There's just too
Okay.
much oil. All of this is being done, you don't sell your oil. I will.
Okay. Okay.
And at
Sure.
the same price, because if both try and sell oil, prices will fall.
But this is amazing for countries like India. Now, coming to Chinese stimulus, Pratik, the first stimulus happened, and all of a sudden the Chinese markets went on a roll. All the FIIs started pulling out from other emerging markets, went into China. But the second stimulus, which was announced post-Trump elections, was a muted thing, and that's where they are disappointed. You see Chinese economy reviving, and you see FII's money going back into China, or they will realize it in a short span of time and come back to emerging markets like India also.
So there are markets, many markets. There is US, which is the largest and it has done the best. Then there is China, which is the second largest, may become the largest. But as a market, as an equity market, it hasn't done so well. And there is India and few others of very similar sizes, 3 to 5 are all very similar sizes. And they have also done okay. Now, a lot of people say Chinese markets are very cheap on traditional valuation matrices.
Correct.
Agreed. Agreed. But then practically everything in China is controlled in some manner or more by the government.
Right.
And then suddenly you will find the valuations are not very different. And the other thing that you need to, so parameters on which that market looks very cheap is market cap to GDP kind of parameters. But then you should also see what kind of profits they make and what kind of return on capital employed they make. See, growth is a large part of the equation of making money, but quality, what kind of return on capital invested that you are making is also a very large part of making money. And there, because of the way that country prices its goods and what makes it so competitive, they don't make so much of money. So they are trading at that valuation. In some
Sure.
manners, it maps to PSUs as well in India. So, freedom to do newer things, etc., etc. So compare these two and you will find valuations are fine. So yes, in a period when one large market like China does very well, and people are not as well invested there, they will all rush there because people of our kind, our mandate is to beat the index. If the largest bit of emerging market index start to move in the manner China did in October, obviously it will suck up money from everywhere, and I made that point. All and more of the inflows of ETFs went to China.
Right.
That shall happen. But that should be seen as a period of time thing. Valuations catch up, and after that, again, things start to normalize. So I think now, whatever caused worry in the month of October on account of Chinese issues should be seen to be behind us.
So now tell us, Pratik, now let's look at the elephant in the room, which is the Indian market valuations, which have, of course, come off from the recent highs after this 10% correction. And plus, earnings have also disappointed this earnings season. So where do you see, is there going to be a time correction, or is there going to be a price correction and a time correction, combination of the two for some more time in the Indian context? Because this is what finally the viewers are looking to get answers on.
Oh, sure. So I have been saying valuations are sustainable even before the fall.
Are sustainable.
Sustainable even before the fall, and now when the valuations are lower, they are eminently sustainable. Safe. So what has happened over the past 1.5 months, to my mind, are a series of events. First, we discussed China. Second, US bond yields moved up. Third, there was an election outcome in the US, which is making the markets there way more attractive, and the money is getting pulled there. That also we discussed. Those are at a point kind of events which happen. It has caused a dip in the Indian markets. Very good. Longer term story stays the same. Now, people point to quarter 2 result seasons being weak. Yes, the start was weak. Most IT companies delivered better than expected results. For example, most banks delivered better than expected results. So if you look at overall result season, yes, X of commodities, a 9% growth in earnings is lower than what we saw over past several quarters,
Correct.
but it was very similar to what analysts were putting out before the quarter. So it was not bad
It is
versus
not a
expectation.
surprise.
It wasn't a surprise. Where the surprise lied was basically in commodities, where frankly nobody has a clue as
Correct.
to how the numbers will look like. So this is how it is. Now, look at quarter 2, was rains were more than usual. When rains are more, for example, you will use less air conditioning. If you use less air conditioning, the electricity bills, your electricity bills, and hence the income of the utilities would be lower. If you have, and in turn, they will need less coal to produce that energy. And yes, if it is raining and you've got an open cast mine, you will mine less. So,
Correct.
you had a great rainy season, which caused some amount of economic downtick. Also, you just had an election in the first quarter, so the ordering by the central government was lower. Now, as you are going into the third quarter, I think signs are pretty good. You should speak to any number of companies, including consumer companies, as to how Diwali went, and you shall be surprised by the answers in terms of positivity. Most companies, including ones in consumers, where there is a thought that they are not doing well, have had a very good Diwali. So look at 30-day period to Diwali, all of it lies in the third quarter, and 5-10 days after Diwali, it's been better than last year
Oh,
by a large quantum, by a
but
large quantum.
auto inventory piling up and all
आप
the.
देखो ना आज के पेपर में आज के पेपर में auto also two-wheelers seem to be fine for this period. So this is what it is, and yes, there are changes in behavior. Uh, you know, in consumption basket, I keep saying, how many more pizzas can you buy and eat to cause the whole population to get fat? People want to do different things with their monies, so you gotta telecom rate increase more seriously. That takes away X amount of money. So there are different uses to which money is being put to. There is no very little stress. If you go and speak to a villager, they've got everything short of money in the bank. Now, if you look at Maharashtra, people are getting money in the bank also.
Right.
So, जो स्ट्रेस की हम सोच रहे हैं वैसा स्ट्रेस नहीं है. It is
नहीं है.
consumption being going to some other region. Now, if you have a good mobile earlier, what caused you to change a mobile in 3 years was the battery not functioning, right?
Correct.
Now, happily, they have put a charging port at the rear seat in practically all cars.
All cars.
So now my phone is going on for 4 years and will happily go into the fifth year.
Correct.
So a lot of things change. And you can't keep fretting, this thing is not increasing, hence things are not good. More seriously, there are periods when consumption drives growth, as was the case between 2008 to 2020. There are periods when capex drives growth, as was the period between 2000 to 2008. We think this is the period when capex drives growth. So started from the bottom of COVID, we are 4 years into it. We believe this thing has further 4 or 5 years to go ahead of us.
Now, we expected that large caps should do better than mid caps and small caps because the mid caps and small caps had delivered phenomenal returns and run ahead of large caps by a big margin. And in this correction also, we are still seeing that the mid caps and small caps have not corrected as much as the large cap space. So your thoughts on that? Where do you see valuations of mid cap and small cap versus large caps, and where do you see value in terms of investing?
No, so our thoughts there have been very different from others. We have been saying this is time for alpha. I'm answering this in a slightly different manner so that you understand. And we don't want to be bucketed in large, mid, and small. That's
Sure.
not our line of thinking. In any valuation equation, the size of the business just does not come in. Otherwise, everything in India should be trading cheaper than anything in the US. Look at their top 100 companies and look at our top 100. Our large caps, by that logic, should be trading at a deep discount to US large caps. The size of a business just simply does not come into valuations. PE is related to growth on the numerator, discount rate on the denominator. Those are the two things. And
Correct.
growth in free cash. So quality is the thing which doesn't come in the equation. It results into free cash and growth. So that is all that comes in. And hence, by extension, in the Indian context, if smalls grow better, they will be valued better. If mids grow better, they will be valued better. If some of these companies become large cap over a period of time, they shall continue to do well. It is not large versus mid versus small in my mind at all. Now, just follow this very simple philosophy that market follows earnings growth.
Correct.
Everybody agrees, very simple.
Absolutely.
Go back to 90s. This is something people will understand very easily. Economy was coming down, we had 91 issues and all of that. But after that, we started to grow. One new industry happened, software, delivered strong growth. New industry, so not there in the index, delivered strong growth for several years. 50
Correct.
to 100% growth each company was doing for several years. And managers first tiptoed there, then went in with a greater conviction, and then even more. So by the time 98, 99 happened, I think portfolios had 10 to 30% software. And
Correct.
it delivered very large alpha because by then software was hardly there in the index. And you had the combo of great growth sustaining for long period, which is what makes money. You go a tad forward, you got a automobile company in the market, delivered alpha. While it was always there, it came in the market. Telecom did that. You go to 2006 kind of a period, real estate that for you. So, but over this period, think of it this way, it is old. So by 2002-3, software is old.
Gold.
Software is already part of the index. It can
Correct.
still deliver alpha because a smaller part of the index, but not very large. What delivered you large alpha were newer names which came in the market. Similarly, in 2006, if you are there, the automobile company, the telecom company are already part of the index. By having slightly more than what is there in the index, you don't generate meaningful alpha.
Correct.
About real estate, we did well for 2 years. Once again, everything is index. You got one new space, you allocate 5%, 7%, 10% to all of construction real estate, you build some alpha. Now you come forward 8 to 20, to my mind, a new industry did not happen in the capital market. Many were bubbling behind. Now they are coming into the market. So, for example, electronic manufacturing was not there in the market, maybe there in the country. Okay, but similarly, new tech. When you order for food and it comes into 10 minutes, so it's not there 5
Correct.
years. Okay, defense was very different. Renewable solar was not there 5 years back, right in the market. Now, I make this comparison with software. These spaces are doing what software did, meaningfully stronger growth versus the index, sustaining for super long period of time. Okay, and this, you know, like I said, when these spaces, new space, when it comes into the market, would be small.
They'll be
They
in the
will
mid
have
and the small cap segments only.
these spaces. So mid
Small,
and the
yeah.
small is anything after
Correct. Correct.
100 companies.
Absolutely.
Okay.
Yeah. Yeah.
But many of these spaces where earnings growth is strong, where growth will sustain for longer, they may start in small. Some of them have become mid. Some of them have become large.
Right.
Okay. So that this part is where magic is happening. Now,
You
in
should
the
not be
index,
bracketing and worried too much about the large, mid, and the small cap. As you rightly said, where the
it
earnings
is
growth
the
is happening is what
tailwind
needs to
of
be.
yes, yes.
Now, one
Because
last, sorry. Yeah, go ahead.
that's all that I was saying. Ki when something becomes large by the definition of the land, something which has not done well will become mid.
Correct.
Okay, and we can reduce something else. And similarly, something from small to becomes mid, which happened 2 months back. A whole chunk of companies became mid, which means, after 250th, a lot of companies would have become small. Stories are not there.
Correct.
Stories are there where, growth is happening and people are moving from small to mid to large. We are very focused there. These are the spaces where earning growth tailwind is there. And if you hold the thought, market follows earning growth,
That's a
we
great
should.
thought. Great thought. I think it should become a tagline now. Markets just
Uh,
follow the earnings growth. So now, Pratik, there were huge IPOs in the markets. So a lot of money got diverted there, and that's the reason why maybe some of the DI money also flowed there. Now, once these IPOs are behind us, and I believe that there are not many big IPOs going forward, will the cash flows of the DIIs come back into the secondary market again and help not only cushion but drive the market?
no, so we are also talking of the same. So IPOs do two things. Yes, they take away some amount of liquidity from the secondary market in the immediate term.
Right.
But what they also do is to get in a lot of new investors into the market. So IPOs are a chosen way of getting new investors in the market, and we are seeing 40 lakh new investors coming into the market on the trot.
Wow.
Now, if those investors have a happy experience, meaning the IPO lists at a premium and stays there, the cycle continues nicely. But if a large IPO cracks and lists at a discount, it does cause some issues for some time. So that is on the IPO side, but QIPs are there and the momentum just seems to be increasing. So I think if markets are buoyant, companies will come for raising money. That is healthy because one should, really speaking, not wish for liquidity driven market move.
I agree.
It
Market should
causes.
find its own real value.
Yes. So we see fundraising by corporates as a very good safety valve. It takes away the excesses. Now IPOs have their life, of their own. So you have to launch them. You launch them. It takes away so much of money. The QIPs behave a tad differently. There is a lot of wish to raise money, but if the market doesn't offer at a particular price, that money doesn't get raised.
Right.
So it happens in a much more orderly manner.
It's a more smart money than.
Yeah.
So now Pratik, your parting thoughts on how do we view the global context, what we just discussed, the macros versus the Indian context on a short-term basis and on the long-term basis that we had just discussed before starting the interview. So your parting thoughts on that. What should investors expect 2025 in the Indian context? Forget the global markets now.
No, yeah. So in the short term, anything and everything that happens around the globe impacts everybody. We do badly, we impact others. They do badly, they impact us. Every action has a very, very quick reaction as well. In the medium to long term, these things matter less. Sanity prevails more. Today, when Indian per capita incomes are seeing an increase, for the same reason I keep saying this, for the same reason that we are seeing more of white goods getting sold, more of cars getting sold, etc., you are seeing a nation of savers converting itself into a nation of investors, and we are getting on the trot very strong inflows of new investors into the market and earlier ones increasing their exposures. Mind you, by some count, Indian equity exposure is just about 4.8% of their savings. For any financial advisor in a young country like us, that number has a very, very long way to go. So it's just the start of that phenomenon. Maybe we have seen it from the bottom of COVID. We are 4 years into it. It will go a very long way. Now, when this is happening, for comparison purposes, look at China. It may be 15 years ahead of us in many ways. This is the longest people tell me they are ahead of us. But from being a net recipient of FPI money, they have converted themselves into one of the largest, if not the largest FPI globally. We are 4 years into the journey, 10 to 15 year hence. Just think of where we would be. The influence of outside money, what happens outside on us would hence reduce considerably. It's already reduced, will hence reduce even more. So it is, our policies, we should have good, conducive, equity-focused policies. Our markets, our fundamentals, our investors, and our market direction. So, just to give you an example, in the Feb to an April kind of a period, other markets did well, China did very well, we were down. In October, the same thing happened, other markets did well, we were down. In other periods, we were up. So it is us, more and more us, who determine what we do, our earnings, our quality of businesses, our investors, our money, less of global influences. They hardly matter. It is
Sure.
our story.
Absolutely. So I hear you say that naturally the valuations are better than what they were maybe a week or 10 days back. Would you recommend investors to now, because many were sitting on the sidelines, sitting on cash, etc., they should be coming back into the system again?
Investors don't listen to us. Investors do that automatically. So, as a evidence, look at inflows into funds on downtick days. As an evidence of that, that you may not get, but October was a bad month, right? Minus 6.5% on the index.
Correct.
But mutual fund flows, very strong flows.
So investors have
Our
become very savvy.
our investors are doing it. Buy on dips is a wave, in the country. Kids who are coming into the market for the first time ask, markets are down, great time for me to invest. I'll get more of the stock for the same amount of money. And like, I'm acha, okay, yeah, you are right. So that is the kind of investors you are getting now. Yes, there is fluff. That always happens. But who knows? Even that fluff may be good and only we believe it is fluff. If you look at aggregates, how the Indian small investor is behaving, it is doing everything that advisors would want to
Them to
advise,
do.
following growth, coming into the market in SIPs. So SIP thing is moving up. More of the mid and small investment is through SIPs. So they're doing everything on their own, whatever we may want to advise. It is time to learn from them. They are showing more faith in the Indian story than many of us. They were the guys who bought India at the peak of COVID. मतलब, I salute them for that. मतलब, उस समय
Wow.
no balance fund manager or any manager who took asset calls increased equity.
Correct.
Indian investor in March of 2020 started
20.
to buy. So there's a lot to learn from them, frankly. They're doing as a crowd, a lot of right things are getting done.
Thank you. Thank you, Pratik. Thank you so much. It was an amazingly interesting conversation. And of course, with your decades and decades of experience and your thought process on both global macros as well as the Indian macros and our way forward for the India markets. Thank you so much. It was a pleasure.
Thank you. Pleasure always. Bye.
Mutual fund investments are subject to market risks. Read all scheme related documents carefully.